Hi everyone, welcome back to the weekly market update. This is Yuchen from Genuine Impact and back again with another video. So before I jump into what to be expected in the next few days, I'd like to take us through what's been going on in the previous week, where we see market volatility remained highly elevated throughout the whole period. Stock market sees some relief rally midweek, especially in Europe and the US, but ultimately all faded away to the end of the week. So looking back, the main contributor to the volatility was Russia's ongoing military operation in Ukraine and the prospect of the tighter monetary condition in response to high inflation introduced by the central banks, as we discussed in last week's video. So all major indices in the US especially has reached a very critical technical level, which is 20% below its all-time high, suggesting all major indices are now officially in bear market territory. And we have also seen some pretty extreme movement in the futures market, especially in commodity and in energy sector, and that would imply a higher inflation to be expected in the coming weeks or even month. So looking ahead of this week, the most important event to watch out for is the FOMC meeting, where the Fed official will make a decision on interest rate level, and the market is currently anticipating a 25 basis point or 0.25% increase in the base rate. What will be quite interesting to see whether the Fed is going to offer any guidance on how high or how quickly they will hike interest rates or reduce the size of their balance sheets going into the rest of 2022, given what's been already happening this year. What I mean by that is typically the key consideration around making a decision on interest rate for a central bank would be level of employment as well as inflationary pressure that's presented to them in the economy. But sometimes they do consider external factors as well. In this case will be the war in Ukraine as well as the continuous outbreak of COVID-19 pandemic globally. On this subject, it's particularly interesting to watch out for any new development in the fresh round of COVID-19 outbreaks in China, as is pretty evident now. The zero COVID policy that China is adopting is probably no longer sustainable or practical, and being a very important element of the global trade, and any potential lockdown in China is going to cause further disruption in the global supply chain, and therefore even higher inflationary pressure are expected for all major economies globally. So what does this all mean for the market and for the investors, and ultimately is this the time to buy the dip? In my honest opinion, not yet, as we're likely to still see some pains in the market in the coming weeks given all these uncertainties, and I do believe the market is still trying to find a bottom. Looking back at what's been happening historically during a quantitative tightening cycle, there are actually some very important technical level to watch out for. My own research of the historical data suggests that the market could decline further by another 10 to 15% before the real recovery can start, but ultimately this will depend on how the Fed is going to play out its interest rate hikes and give any guidance on what they are going to do in the rest of 2022 and beyond. So it's very important to keep an eye on what's going to happen on the 16th of March and how they will describe how they're going to make decisions going forwards in terms of making interest rate decisions. Without a question, we're all experiencing a downward trending market at the moment, but it's not a time to panic. For all of us, it's the time to be more patient, and is to learn from what's been going on over the past few months and understand what's been causing the situation in the first place. And it is now more important than ever to manage the risk in your portfolio and make sure you have a diversified range of investments that can protect you through all different kinds of storms and volatility heading into the rest of 2022.